And they only know one thing: markets always go up.
It should be crystal clear now that the Fed is being slaves to the bubbles that they blow.
They will go to lengths that will make what they've done so far seem, trivial.
If you have a look at what Joe Biden does, he basically decided that the country needs to undergo a big transformation, and probably a transformation that we haven't seen in generations. We know that Joe Biden is probably going to be a one-term president, and he doesn't have too much time. So I think, as I've said, he will continue to push the envelope, and then of course this basically confirms our view that we already had before COVID, that we developed while listening to super boring speeches by central bankers. But they always said, well, we have basically done what we could after the GFC. Now it's a turn of politicians. Now it's a time of fiscal policy. And this is happening. And, in short, austerity is out. Nobody cares about this frugal Swabian housewife anymore. Nobody cares about budget surpluses anymore. And I think this much higher importance of fiscal policy, and also this merging of monetary and fiscal policy is something that will continue for the next couple of years. It should be crystal clear now that the Fed is being slaves to the bubbles that they blow, and I've really got no idea if there's any out from their point of view. What we really see now, and I can feel that, is this what Mises would have described as a crack up boom. We're seeing it in real estate all over. I just saw recently that an Italian artist sold an invisible piece of art for $15,000. So we're already seeing this craziness of the environment that we were pushed into. And
but why not, Ronnie? They're selling invisible money for $65,000. Although it's gone down to $32,000 now. So why not sell invisible art? As I said before, the dilemma is that people have now been conditioned to markets always going up. So for the majority, certainly of individual investors, but also of institutional type investors, they know nothing else, and I think the reaction, to the next fall, when that comes, it'll be the same as before. It'll always come back. We'll wait. The central banks will come in, etc. And then at some point, as we know, when the bear market starts, and as I said, I've seen enough of them, and the one in 73-4 was one of the biggest ones, but all of those have been short bear markets. We've never seen, or any of us in our lifetime, a bear market like the 29 top, and then the fact that it took the Dow 25 years to come back to where it was in 1929. None of us have seen that. Now, as I read the world, the bubble now is greater than ever in history. And therefore, I don't see any reason why this coming decline, this secular decline in markets and the world economy that I expect, because it's global now. It's never been global before, never. It's been in individual countries or regions, but not global. And this time it's global. And therefore, I think the risk is greater than ever. And therefore, your warning to investors is absolutely right. But I mean, I would be a lot stronger than that, because I think investing is all about risk. But people don't understand that today, because there hasn't been any risk for a long time, because everything just goes up and up, and it's different today. It's never going to go down again, market. But that ain't going to be the case.
Liquidity is what's put markets at all-time highs. Liquidity is what stopped the bank runs back in 2008. Liquidity has been the fuel for this. And so away from the headlines, there's a guy called Michael Howell who runs a firm called Cross Border Capital, and they monitor liquidity flows. And they put out some great work on this, and they've posted a couple of charts recently that show that cross-border liquidity is declining quite quickly now. And the problem here is that the thing that retail investors see in the headlines, they see markets going up, they see stock prices at all-time highs, they see people make money in crypto, they see all these wonderful things happening. What people need to understand is, away from those headlines about markets at all-time highs, what the professionals see, what the professionals have access to, is information that retail investors don't have. And that information, reverse repos being one of them, suggests that there are warning signs flashing about liquidity. And if liquidity dissipates in this market, then the markets will go lower, make no bones about it. If there isn't ample liquidity, then markets are going to struggle. Because if we do get that deflationary shock, we've already seen what they're going to do. They will go to lengths that will make what they've done so far seem, trivial. So we can expect a monetary blitz. We can expect a fiscal blitz. We can expect them to cap yield curves. We can expect them to do all kinds of things. They will do anything at this point to stop that deflationary pulse taking hold. So while you may get a deflationary outcome in the short term, I personally have come down on the side that long-term inflation is the thing I have to be most concerned about. And I've talked about this before in other conversations, but the big thing for investors is to understand that if you've had a portfolio that has been set up to benefit from a deflationary tailwind, that portfolio has performed very well for 40 years. It will perform terribly if we have an inflationary environment for obvious reasons.
Returning to the gold market, it's pretty interesting what's going on at the moment. First of all, if we remember last August, when gold made new all-time highs, everybody was talking about gold. Now we're trading at 1800 and nobody cares about gold. Goldman Sachs was recommending shorting gold. UBS said gold will see further downside. So I think, we're basically hovering below the all-time highs, and the fact that the sentiment is so negative, that's a pretty positive sign. Then we're seeing, for example, some pension funds going in. There was the DSM fund from the Netherlands. It was pretty interesting to read their statement. They say they are reducing the fund's exposure to government bonds by 10 percentage points because of the very negative expected return on the asset class. So, they're selling bonds and they're buying commodities, they're buying gold. I think we will see many more of those statements. Then if you have a look at COMEX gold deliveries, they continue to be extremely strong. In some months, they're 3 or 4 times higher than the average. So that tells me that people now really want to hold physical gold and not paper contracts. Yeah. Then we're also seeing lots of demand from the central banks, the Hungarians. They had the highest hyperinflation in the history. They were buying significant amounts of gold. The Polish, I think the Russians just recently said that they will buy 4 billion. 4 billion, yeah. And that they got rid of all their dollar reserves. So there's quite a lot of interesting things going on. On the other hand, nobody's talking about gold. So that's a pretty good setup, I would say.
But pension funds, I think, and I've been saying for a while, I think that will be one of the major groups of investors into gold, for the simple reason that if we are right, the three of us, that we are leaning to the inflationary side of the world economy, and therefore pension funds and institutions would be obliged to inflation protect their assets by holding some gold. And we saw the first one was the police and fire pension fund in Ohio, and then saw the Dutch one, we saw the Swiss one, the cantonal one also now recently, putting it into physical outside the banking system, which is interesting, not even into banks, not into ETFs. So I think that trend will accelerate in coming years. Obviously, pension funds take a long time to make a decision, but it's quite significant that this has happened now. And I think there will be a very strong trend going forward. And of course, as we know, there won't be enough gold for pension funds having any major allocation to gold, and the only way they can have a bigger allocation is just by a higher price, not by because there won't be any more gold produced, and there will be very few sellers of gold.